Good afternoon, everybody. Welcome back to the Schwab YouTube coaching channel for our next topic, advanced charting techniques. I'm your host, Kevin Horner. I want to thank you all for being here today. It's been a bit of a rough start to this Friday and a rough end to a volatile week. We, of course, are going to do a little look at the market, brief review of what's changed since I hosted Trader Talk with you all this morning. And then we're going to dive into a brief shift on a look at RSI, the Relative Strength Index, as a potential way to look for possible reversals, maybe a little early to the party, but we'll further explore that idea and talk about the potential to utilize our basic risk management techniques as we look to maybe participate in a market that's kind of proving to be a little bit difficult. So we'll cover a couple of key thoughts today, and then we'll let you get on your way for, heading towards the weekend. But of course, this is not the last class of the day, so make sure you keep it tuned right here. Now, I'm joined today by my friend Barb Armstrong in the chat. Say hey to Barb. She'll get to comments and questions I'm unable to. Excuse me. I will certainly keep an eye on things, though. I want to hear from you and try to answer your questions as I can on the fly. So please feel free to post in there for the duration of our show. And remember to follow Barb and me on X, Barb Armstrong CS, Kevin Horner CS. The best way to find us coaches when we are not offering you these classes here on the channel. All right, let's get to our disclosures and we'll dive into things. First, remember that everything we review and cover for you here today should be considered informational and educational only. We are not making any recommendations here, nor an endorsement for a specific approach to trading, but we are going to utilize technical analysis, of course, and it's unclear as to whether we'll discuss options. I say that because I like to do these things on the fly to a certain extent. Maybe there's an opportunity that we'll find that could be pertinent for an option strategy. If we do cover it, you need to know options carry a higher level of risk. They're not appropriate or suitable for all of us as investors and traders. You do need to be familiar with the characteristics and risks of standardized options before any option transaction. That falls under the basics of just knowing how markets work, of course. But ultimately, in order to trade options, remember, you do need to be previously approved in order to do so here at Schwab, so make sure you're going through the needed steps. And then lastly, we do work in a paper money version of the thinkorswim desktop application, and which means that not all of your detail will be up to speed. And what I mean by that is, as we will discuss a scan here in the discussion in the class today, that scan is likely not going to be available for you in use of your paper money platform. So you will, as a reminder, want to use the scan in your live version. If you want to take any results from your scan and apply those into a paper money, that's fine, of course. But in terms of building the scan and utilizing it initially, we will need to have that in your live version of the platform. Okay, now, as I mentioned, we're working in paper money. So the one last note about options is that while when we work in options and selling of options, for example, one thing we never do early in paper money, we will not get early assignment on your short options. So just keep that in mind. That is absolutely something that can occur in any live market. And in fact, the moment you sell an option, you are at risk for early assignment. Now, there's odds of that happening versus not happening, but nonetheless, keep those things in mind as well. Now, as I mentioned, we're going to do a brief review of what the market looks like here. The S&P 500 has traded through the low we created yesterday, and to this point, we're kind of holding on. I'm sure traders are feeling a little bit uncomfortable as we test the levels of support, and if we went back and looked at that same level that we talked about this morning, it would basically be here on the S&P 500, right around 6520, down to the round figure of potentially 6500, under which things get a little indecisive and uncomfortable, perhaps. So again, traders, we need to know where we will change our view of things. So make certain you're taking those steps, you're building out a plan, you know where your view of the market changes and where you would take action. Now, of course, as we look at the S&P 500, one of the charts that I've been bringing up a lot is that intra-period look at oil, VIX, and the S&P 500 futures. Now, these are futures symbols. We're not recommending futures trading, of course. We're looking at this for an evaluation of the relationship between these three instruments, nothing more. But if you do wish to trade options, make sure you're familiar with futures. That is, make sure you're familiar with the futures risk disclosures. That's another scenario where you need to be previously approved before placing those types of trades. And the takeaway here, everyone, is that, you know, looking at where we peaked in the S&P this morning, real early on an overnight basis, we got up to that 6670 level. And you know what? Right around that same time frame, that was when oil was bottoming out for the morning, so to speak. You know, at 2 o'clock overnight, we had oil rallying. We're up to almost 98 a barrel. I mentioned this morning the $100 barrel level is not just psychological, but an important level to eyeball. And as we get into 100 or through 100, we are apt to see some reaction from the S&P. Now, the takeaway today thus far has been, as it relates to the S&P, is basically lower highs failing at resistance, right? And in fact, we opened today and have tried to stabilize, but you'll notice that in our stabilization here, all we've done is basically revalidate resistance at around 6,600. Again, 6,600, that's the futures value, not the SPX value. So I just wanted to remind us of the relationship we can eyeball here. And then if we looked at the intraday on the S&P, that's my line from the daily chart, of course, right there at about 65.20. Here's what I'm talking about. A breakdown. Yes, we've held the low in here, right? Probably make that a line instead. But ultimately, we have stayed below that trending 20-period exponential moving average. We got above it quickly yesterday, and it was really for that second half of the day, the last 2 hours of the day. But notice, we did not make any higher highs. We made a matching high, or a high that took us to the gap that we created from Wednesday into Thursday, and then we rolled that over. So that's not a great indication, everybody. In fact, if you were the trader back here, willing and maybe you bought all of this up here, you bought inlet lows, you said, I think that there's an opportunity. My hope is that you were thinking about this on the tighter window of time, utilizing either 15-minute bars or hourly bars, and thinking, all right, if we are going to rally, where are we most likely to pause and become and start to think about, can we push this any higher? Well, commonly that's going to be the gap zone, right? The gap levels can be really instructive for us on moves through resistance to the next layer or moves through support lower to the next spot. So be attentive to your gaps as usual. Now, today's action, we don't like what we've seen, but we've managed to maintain the 65.40. So we're going to eyeball it for the remainder of the day. And if we can recapture 65.65 and start moving back higher, well, then the pivot point up here that we really didn't visit much today was, we were below it at the open all day. Basically, we have a chance to get up to 6,600, but you got to clear that first R1 with some kind of conviction. Now, last note as it relates to maybe not the S&P specifically here, but these pivot points that I'm highlighting is one thought process that is a way that traders will look at this. So if you're utilizing these 5 or 15-minute bars on your intra periods, you want to be above the, in this instance, because we're below it, we want to be above the S1 level. We want to clear and hold it. And what you're looking for are 2 or 3, maybe even a 4th bar, which would be up to an hour, really, over that green line, right? So if you get above the green line, we want to hold it. We are fine with staying above it, even if we don't immediately cruise higher, as long as we maintain over 3 bars or so, not making a lower low. So if we can get above the downtrending exponential moving average line, that's the 20 period, and the S1 line currently acting as resistance, hold it for what could be 3 to 4 bars, well, then potentially we have a new short-term floor possibly established. Okay, now that is very short-term stuff, everybody, but I wanted to give it to you because it absolutely could be pertinent for the remainder of the day. Barbara, great question there about a webcast specific on pivot points. Sure, we have more than a few. In fact, the great thing about the YouTube channel we call Trader Talks is you can use our search engine right on the homepage there to search for exclusively pivot points. And you're going to find a number of sessions where we highlight that specifically. Further, if you're looking for that potentially in a class setting like this one, they are frequently on my charts, basically on my intra-period charts all the time. And so anytime I work with intra-period, you're going to see those pivots. And I'm hosting your Trader Talks on Monday, Wednesday, Thursday, and Friday. So from a standpoint of practical application, perhaps the Trader Talk segments are a good one to check out as well. Okay, quickly, let's peek in on the NASDAQ 100, which is showing a little bit more weakness. You know, the weakness we've experienced in the NASDAQ tied heavily to what's gone on in semiconductors. But you can see there, we've traded through the low we created yesterday, intraday. We basically have created the same setup in the NDX that we created yesterday in the SPX, right? And basically all you're seeing here today is going to line up similarly. So you've got a low that has been held all day today thus far. Doesn't mean it's going to hold today, but it is currently doing so. And we're testing it as we speak. Can we get off of it? Can we move through the 20-period EMA? Can we get above the S1 level once more? These are what we're thinking about as it relates to the NDX as well. Let's look at our small caps. Small caps really taking it on the chin, down 1.4%. And here is why, everybody. Look at the move in the 10-year yield, 10-year cruising to the upside. I tweeted about this a little earlier. This is forcing traders to rethink the expectations for the broad market, largely because following the FOMC decision this week, where we had no changes, with some commentary that validated the idea of higher for longer in terms of yields and rates. So if rates are going to stay elevated, that is going to put the pinch on margins for these small cap companies. And that's one of the reasons you're witnessing small caps be off a little bit more here today. And then the semis, like I mentioned, I'm watching this one because this has the makeup of a bit of a technical move, doesn't it? We've broke the 20. We've been below the 20 for a bit here, basically the entire month of March. And we also broke my uptrend line that I'd had in here over the last few weeks. So we used our low as a buy. You had buyers step in here. Great. You rallied into resistance and have now rolled over. Now, I say rolled over because we've not been capable of getting through that 79.20 zone, right? So that stands out. And while we've not traded through yesterday's low just yet, there is nothing about today's candle to this point that is very bullish, right? You know, essentially we have put ourselves at a level where we know where risk changes, or we know where we can become more bullish. Unfortunately, it's at least 7,900 and possibly as high as 8,000 on the SOX here, because we got to clear that 50-day moving average. I draw that line in somewhere around, like I said, 7,900. But you know what? Depending on how you choose to do this, as we often say, technical analysis is by no means a science. So draw your line where you find it to be appropriate, kind of stick with it. But if nothing else, that ledge that about just shy of 8,000, over 8, if held, it'll look a lot different, wouldn't it? Doesn't look so fantastic right now. So all of this in mind is to put into context a little bit of what's going on a longer run basis. And so let us, as always, pull back the curtain a little bit, look at that weekly moving average or weekly long range trend. I'm utilizing here the 5-year weekly. That puts us back to 2021 or so. And I think it's important that we not only visually see how these pullbacks appear, but also make note of the levels to which they may fall if the short-term downtrends play out. And I think that's the reminder here. I'm going to extend this time frame. Let's go to 10-year weekly. So remember that within trends, right, all of our trends have trends within trends, right? That's one of the things we know about technical analysis, is that it acts in a so-called fractal nature. We can apply our concepts from a weekly chart into a daily chart, into a 5-hour, 4-hour, 3-hour, 1-hour chart, or into a 5-minute chart. We can take the same concepts and views that you get in longer term windows and apply them to shorter term windows. And what we're in the midst of is a long range bullish uptrend. It's hard to call this anything other than that. This is 2016 spring window here, right? And we could draw a trend line through the lows that we found here, possibly through this low, possibly through this low, and it certainly looks like these levels have been supportive. Now, one other keynote here, everyone, when you're thinking long term, my friend Rachel Deshelle likes to remind me, Kev, you need to ensure you're looking at logarithmic scaling. Otherwise, your trend lines won't validate. They won't make sense. Here's what I'm pointing out. If I open up my gear, everybody, and I go to price axis here, you'll see I'm using the log scale. Well, look at the difference. So here's what it looks like initially, right? This is log scale on the SOX. And let's look at it without log scale now that I've unchecked it. Hit apply. And my goodness, everything looks extremely skewed. Now, that doesn't mean it's wrong. It just means you can't really validate these price levels because it's not taking into account prices on an equal basis. So when you use logarithmic over typically I think of it as using it when your period exceeds 1 year. This is why. So consider this, making it a log scale. Again, I went to the gear, price axis, and log scale, and that's going to give you a better visual reflection and understanding of price action on a historical basis when you make big swings. Remember that, big swings. And that's what we're talking about in terms of prices like these. I mean, you're looking at a space that rallied off of that tariff low in April of just last year from what, 3,400 all the way up to 8,500. That's significant moves, right? Very significant. So big percentages, big point moves. We want to make sure that everything lines up and makes sense. So consider utilizing those logarithmic views. Let's talk about the S&P briefly over that same window. And again, we're seeing something that's a little bit more volatile and maybe a little more difficult to track, partially due to the fact that the semiconductors have been so strong for us for so long and so important to what we do collectively as a country and why we need access to that stuff. The S&P is not quite as clean with your trend analysis. Yes, we had that drawdown in 2022, or late 21 into 22. We found the bottom in October of 22. We started that rally up. A lot of traders would start from that low and try to capture the low that we found in April, the tariff low that was. You'll notice that when I draw that line in, the tariff low looks very limited in scope, right? 1 week below the trend line, 1 week below my 100-week moving average as well. So keep that in mind. Oh no, Gina, no. Gina, with regard to the logarithmic view, no. When I'm looking at my daily chart, there I do not incorporate logarithmic view, even though it's 1 year for the most part. I think I'm on a 1 year. Yep, I keep that standard. Okay, so my basic chart standardized. I mean, this is a big move in the SPX, but not so big that the logarithmic viewpoint is going to change it. Here's what it would look like in log. See, not a huge discrepancy, right? Everything kind of holds. So, oops, grab the wrong one. So just be aware. Again, kind of the window, I think, is when you get to 1 year, that's when we think about, when we get beyond 1 year, we start thinking about using log scale. Okay, so like I mentioned off the jump today, I wanted to bring you an idea to maybe do a little bit of bottom fishing. And I know not every trader out there is intent on buying stock that are depressed in nature. However, some of you are going to be intrigued and want to look for those opportunities. So we are going to take a look at the scan. And what I've done here today is to shift my basic scan. And I say basic because I'm commonly looking for stocks already in uptrends, trying to find those equities that have already traded above a 20-day, already traded above a 50-day, already trading above a 200-day, all simultaneously. This lets us know that we have stocks that are in uptrends over multiple windows of time. Well, today, what I've done in the scan tool is to take that same concept, but invert it. So we're still incorporating average volume here. We are want to have greater than 500,000 shares, but I've told it that I want to see stocks whose closes are under a 20-day moving average, under the 50, and under the 200. So we're finding downtrending stocks, okay, and we're hoping to utilize something like the RSI to help us discern whether we have new opportunities to trade potential relief bounces. And that's what I want to refer to these as, relief bounces, because we are in downtrends. Every one of these positions that you're seeing on my scan initially here, let me go ahead and hit that button for a rescan. Okay, we lost one. We were at 14, now we're at 13. But every one of these, by virtue of the scan, are below their major moving averages. So we should be witnessing downtrends. Now, what I've also incorporated is a study in utilizing the RSI crossover. So I got that by adding a filter, selecting study, and then, of course, the study defaults to that ADX study. I eliminated that and just went to crossovers and selected RSI crossover. Then the default there is when the RSI crosses above the 30 line, which is the standard oversold condition relative to RSI, utilizing the 14 periods. That again is the default for the Wilder's RSI, J. Wells Wilder, who created it. But what I've changed today, everyone, is the exponential from the Wilders. Now, I'm not going to explore the others, but I am exploring the shift from Wilders to exponential. So first of all, let's leave it as J. Wells Wilder's initial default RSI, hit scan, and we will find that, oh, I had one or two earlier. Okay, now I've got three. Okay, three stocks using the traditional Wells Wilder's viewpoint on RSI crossovers, moving from below to above the 30 as a potential join the party, so to speak. So let's just quickly look at those: MTB, FITB, and Cintas. So down below, you'll see there we are. RSI reached oversold conditions. Could this be opportunity? Sure. Now, I know many of you out there are of the belief that every scan you do should only give you immediate trade opportunities. However, I am not of that belief. I am of the belief that every scan creates an opportunity to add a security to your watch list. Now, if you look at MTB and you say, hey, we're hanging out close to the 200-day moving average, we're discerning whether the 200 could hold. We have not had enough clarity, but we're seeing a bit of a divergence with the RSI moving out of oversold conditions, potentially could be setting that up, right? So this is possibly an entrance, even utilizing Jay's initial breakdown. Here is what Cintas looks like. Let's take a quick peek there. Now, see, that looks a lot different, right? We're not sitting on or close to the 200-day moving average. This one is maybe holding an area of horizontal support. So some traders could certainly look at this and say, yeah, I'd be willing possibly to take a chance, except what I'm noting down below is I've already made my adjustment to my RSI. I made a mistake here, everybody. I apologize. I'd had this set using Wells. There we go. There we go. Make that change. So here, now it looks like we've got an RSI crossing the 30 line. I apologize. That should have been defaulted to the norm, but that's what I'm getting at. So this is certainly an art I completely understand where you're coming from. Bottom feeders don't taste very good. You're not wrong. Not every trader is going to be comfortable being a buyer at support, but nonetheless, I am of the belief that our job is just to build a list of ongoing potential scenarios, potential opportunities to take advantage of, and we as traders are going to find those opportunities to kind of put our money where our mouth is, right? We're going to maybe step in and you get a look at what happened here. Maybe there's a reason to believe that Cintas holds this 180 level. We go back and look at it on a weekly chart. We could extend that white line to the left, and I'll note that, hey, that still catches some prior levels as well. I mean, there's certainly been some horizontal support in here, so it looks like there's reasons for why it held up where it did. That doesn't mean it's going to continue, because when you look at the long range trend here, everybody, on Cintas, boy, that 100-week, which was pertinent and perfect for us until just the last couple, this level up above us, or excuse me, right beneath us now, looks very important, because this looks like, I don't want to circle there. I want to make that a line. Try that again. All right, right through there. Nope. All right, so Thinkorswim is going to take a second to think about whether or not I can have access to a line there. And let's see, maybe. Come on. There we go. Let's try one more time. All right. So we have what could amount to like a double top formation up here. And if this is a double top formation, then we don't want to see it beneath the layer of support. In this case, support would be considered, we'd call that the neckline of a potential double top formation. The thing that stands out negatively about the bounce back is the fact that the bounce back was rejected at a lower high, rejected at the confluence of those moving averages. So that stands out. Kind of looks, I mean, head and shoulders, not as much as maybe double top. Could be head and shouldery, but really whether you call it head and shoulders, double top, breakdown, and bear flaggish type rally, none of that matters nearly as much as the levels that could be violated. And if violated, what action do we take? Well, for Cintas, at least, it looks like a lot of traders would maybe lighten up longs on a move under 180, because under 180, we have to start finding other areas of potential support. And if you go back to when the market was its weakest, well, Cintas was participating in the same way that the broad market was, right? In 2022, it was rough, and we got going again in 2023. So this level probably is representative of a Fibonacci retracement level. Let's just go ahead and take a peek. Let's use the absolute low. You could do either one of these, and remember, when you're using draw tools, all of this is in the eye of the beholder. But some traders would draw it from the absolute low of the retracement there, the lowest in the drawdown. Others might look to the low that was created on the throwback originally here, and that kind of validates that 38% level. We're pretty close to it, right? Within about, what, $4 or $5 of that low. And over a window as long as this one, that might make some sense. So I wanted to highlight that on the differences here between the scan using J's initial defaults versus making an exponential look. So we're going to take the exponential look now. I'm going to hit scan. I'm going to go back to my chart. I'm going to go into my studies. We're going to update the study for the RSI so that our line matches our scan, right? So here I'm changing from Wilders to exponential. There we go. And apply. There we go. And so now you see Cintas, according to exponential, Cintas is not moving above the 30 line. So with that in mind, you may wait, right? If you were a believer in the idea that the exponential RSI was your signal, then you would sit on your hands and it wouldn't even make the list, right? It's not in this list here. In fact, I've already created that list because I went in and saved my scan, titled it SPX downtrend but oversold, in the belief that we might find something. By the way, look at what sectors are in here. Mostly financials. That kind of stands out a little bit for us. Tells me something, right? I mean, financials have been beaten down. We've obviously had a bit of a credit crunch, so to speak, on the private credit side of things, and it's been weighing on banks broadly. Now, I want to point out, as it relates to, I'm going to put Adobe in the chart here briefly. As it relates to the RSI, I want to just give you an explanation of what you can think about with the traditional RSI, named after J. Wells Wilder again. So that uses a smooth moving average of gains and losses over that 14-period window. And the smoothing of the average makes the RSI stable and less reactive. But when we change that to the exponential RSI, it uses the moving average that is exponential in nature instead of a smooth moving average, which means we witness reactions that are more quickly tied to recent price changes, which gives weight to the recent data over the other data. So yes, this can give you faster signals, but ultimately, it can also give you more mixed signals, meaning they may not be as reliable, okay? So Wilder's RSI may be more steady, while exponential RSI could be considered to be more reactive, all right? Now, when we look at Adobe, we've got a stock in a pretty healthy downtrend. Evidence being the blue 200-day moving average, way up there in the upper left to the lower right. And we are a pretty good distance away from it, about 85 points or so. Now, what stands out on this? Well, we've got a couple of low levels that have been achieved over the last month. Market's been difficult. We bounced off of this initially, rallied into resistance, did not make a higher high. We made a matching high, failed, and came back to test. But all the while, we've got a rising RSI, this exponential RSI, and today we're back above the 30 line, okay? Now, reminder, not every instance back above the 30 line is going to be a wonderful move to the top of the range like this was. It's not going to be that way every time. So what do we do as traders? We try to incorporate trade process, right? If you are unconvinced but compelled to take place or participate, you could be a buyer down here with 25% of what you consider to be a full position size. If you are fully convinced, maybe you start with a full position and you have an exit strategy beneath today's intraday low. Again, the bullish divergence in price may give bulls a bit more confidence to be buying here, but by no means does that indicate that price can't go lower. So it's imperative that we build in that possibility that I could be wrong about stepping in here. If I am, and we break down under 245 as an example, well, then maybe I don't want to be in this for the short term because I am taking on greater risk. So this is exactly why I like your question there. So your question here is, when do I enter the trade, i.e. with a moving above the moving average? Do I wait for price closing above it? Do I enter the next day at support? These are all excellent questions. Now, the best way for me to answer that is that I can tell you that traders will take all of those concepts and may use any of them to do this particular approach. But if we were going to use Adobe just as an example today for those purposes, and we were going to say take a 3-stepped approach, some traders might take the idea that this is their opportunity to be buying in at what could be a significant low. And let's just see if this lines up with anything historical. So I'm putting on that 10-year weekly. Boy, we took out the last low, so there's not a lot that's looking terribly wonderful about this, right? Could this be support? Sure. Does it have to be? Absolutely not. But let's do it from the standpoint of a 3-stepped process. If this were a good low, but I'm unconvinced about it, we might be willing to step into a 25% position. So let's just say it was buying 25% here. I'm going to do this differently than I normally would, everybody. I can get my fingers to do the walking for me. So let's say we are a buyer, 25% position here. Then I'm going to put that over here so it's easier to see. All right, so there's your 25% position. You've got a stop order or an exit strategy beneath, which could mean a stop order, market order to sell once triggered. You put a price beneath us by some amount. You could incorporate an average true range to set that. That means you're risking 10 points beneath 10 points because our average true range down here shows up as $9.84. You can see it right here where my little cursor is. I hope you can see. So $9.84 below my current low. That would be an appropriate level for some traders. Now, you could also decide to do a married put. Maybe you your 25% position size could be 100 shares. That'd be a lovely development if we had that as an option. Maybe you own 100 shares and you buy a put simultaneously for protection. You could do that as well, but that does increase your cost. You have to be aware of that. Now, if we're taking the standard equity side of things, then a trader might think, hey, my greatest opportunity occurs when we make a new high. So we could look at, could we use the 50-day and a close above the 50-day is spot one where I might add my a second 25%. Or if we make a new high, we could add a second 25% and then see what goes. If it rallies into the 200-day and fails, traders need to be prepared to take those profits and move on. But what if this were the end of the downtrend and we got above that 200-day moving average and we started developing a new short-term uptrend? Well, then some traders would take that third position of adding the last portion, 50% of ultimately what they call their full position size. And that might have them being a buyer. And again, I've got to remind ourselves that 200-day moving average is downward sloping. It is not going to suddenly reverse and start heading upward. It's going to first flatten out before it starts to curve up. So as it's sloping down and flattening out with price increasing, it can still act as resistance, much like it did right in this zone. Okay, so we traders need to be thoughtful about that and have that plan. So 25% buyer here, potentially a second layer for the second 25% of your original full position size. And then up to the 200-day, it becomes a decision. Do I take profits, move out of what I've put onto this trade, or do I potentially just use a short-term moving average and only sell on downside weakness? Meaning, if this is a new developing uptrend, I have an opportunity to stay in a position that I bought at really good lows, because by the way, if by chance we are in our position that we picked up here and up at the 200-day or approaching it, we might be up 35+%. Well, we don't want to give that up, but at the same time, if it's going to keep going, we want to stick with it. So that's where we may very well start looking at using short-term trending moving averages to validate exits on short-term weakness, as opposed to selling into resistance. There's tons of ways to go about this, of course, everyone. The market will give us plenty of opportunities to try out new ways to trade. Be a seller into strength, be a seller only on weakness. It all is at our own discretion. The question is whether we've learned enough lessons to pinpoint the way that fits for the way you like to trade, right? For me, I've had so many lessons that I know my own process personally, right? I know that I prefer to sell into strength a little at a time as opposed to selling on weakness, but that doesn't suit all of us. So know what it is that drives you and be thoughtful. Have you been the trader who sells at resistance only to watch the stock go higher, and that irritates you more than being the one who holds at resistance only to watch it retreat? You know, these are the things we have to learn and determine for ourselves. So, saw the request there in the chat, like get the scan to you. I'm absolutely going to do that. Again, we have changed my traditional scan, so it is a downtrending scan looking with RSI crossovers and altering to the exponential RSI in lieu of the standard J. Wells Wilder RSI. So I will share that with you. Remember, please, that all of our shared scans and scripts, these are not guaranteed for timing nor for accuracy. And also, when you load this up, everybody, here's how it looks. Don't forget, so just copy paste into open shared item. I know many of you are familiar with this, but I'm just going to remind you that when it's time to actually import it and you hit preview, the best thing you can do for yourself is to give this a name that is going to make sense, right? A name that you can reference very easily. So as you can see, it's loading there, and then it says import item as. Well, guess what? Every single time you import a scan, it's going to begin scan query, and it's going to give you the date. Hey, that date's helpful, but not as helpful as saying something like oversold exponential, how about just Expo RSI and SPX, right? So now I know definitively what I'm getting when I do that one. Oh, that's a good one. Zinc, I like that. Catching falling knives. Why not? Why not? That can work just as well. So yeah, let me share that with you all. It's right here in the chat. There you are. Okay, excellent. And again, I know that the market's giving us a little bit of fits, these last couple of days. My hope along the way is that the classes that you're taking here, you're watching here every day, are doing a good job of reiterating some of the process that we traders need to maintain. Remember, the key to long-term trading success is discipline and consistency. I can't tell you all of the specifics about process that are going to make it work for you, but I can tell you that if you stay disciplined to the process you set for yourself and you're consistently taking that same process trade to trade over the long haul, that's where those rewards come in. Remember, it's small things that we adhere to day to day that become bigger, well-established habits over the long term. That's what we're always striving for. So with that, we'll go ahead and wrap up today. I hope this was helpful for you all. More to come from us on the channel, of course, but please follow Barb and me on X at Kevin Horner CS, at Barb Armstrong CS. If you liked this one, I don't do this one too frequently, so I would love a thumbs up from you down below, everybody. Really helpful as we get this reviewed and archived into the platform for you a little later. But always have a great rest of your Friday here. If the market's doing what it's doing and it's working you over a little bit mentally, just go ahead and shut it off. There's nothing wrong with stepping away from your laptop and catching some rays of sunshine. Hopefully you got them where you are. So have a great afternoon, a wonderful weekend, everybody. I want to thank you for being here and for being a patron of the Trader Talks channel. We greatly appreciate it. Hope you have a wonderful afternoon, and I'll see you again real soon.